So I'm reconnecting Zoom to Restream. Let's see if Restream likes that. Okay, it says offline. Now it's getting online again. Okay. All right, seems to be happy with that. So I'll leave that and I'll come back to you guys now. All right, so I think the last thing that I was on before I got disconnected was about US persons whose tax liability has, or the issues with the IRS has meant that they have issues with their passport as well. So essentially, historically, you're correct. The Internal Revenue Service, which is part of the Treasury Department, didn't necessarily communicate with the State Department. So Treasury and State didn't really talk to each other, but now they do. Rules have been instituted. More importantly, policies and procedures are in play, which means it's happening more often than ever before. So we have had clients who, for whatever reason, they, when you're traveling, especially, if it's super important to be on top of your mail. It's really, really important to be on top of your mail. Whatever mailing address you provided the Internal Revenue Service with in your last filed return, make sure that there's someone there who's paying attention. And we've had situations where people are traveling or they're working remotely and they left their brother, sister, parents, whoever it is, pay attention to the mail, and they don't. Something comes, they think it's junk mail, they don't open it, they don't check. And it could be a bill, and it gets worse. And once the liability is over $50,000 and the IRS is not hearing from you, it seems like it's almost automatic that something goes to state and people have problems with their passport. So we've not seen any situation where your passport is just canceled. But what happens is when you go into the embassy in whatever country you're in, and especially you'd routinely go in to get your passport renewed, or maybe it's been lost or damaged or whatever that case may be. And you go in and you're able to verify your identity, and the embassy's telling you, sorry, we can't help you because there's an issue with your taxes. So it is very, very real. It's not a rumor. It has happened, and it is happening, and it will increasingly get worse. So please stay on top of your mail. If it is that you are no longer at whatever address you were in the US, and I'm speaking to US exposed persons, make sure that there's a form that you can fill out to update the IRS, let them know that you've changed address. There's also a new facility with the IRS website where you can log in. And there's obviously a lot of identity verification. But you can log in and you can see all the correspondence. You can see your prior tax returns. You can see what's been processed, what's in the queue, whatever. So get onto the IRS website, irs.gov, and register your account. Just, I think it's definitely worth it to stay on top of things, especially with the whole health situation, which I can't use the name, otherwise we get censored. So we know there's a health situation going on. And as a result, IRS processing has just got worse. So we have had clients abroad in the Philippines, in Australia, in Singapore, in parts of Western Europe, where they're missing IRS notices. So, and they will get a notice of a lien or asset seizure, and then they're like, we didn't even get a warning. We don't even know what's going on. We didn't get the prior notices. It's happening all the time to many people. It's not just you. So the point is, get onto irs.gov, register, and stay on top of all those IRS notices that may or may not be going to you. Hope that helps. Moving down. Okay, someone has a long question. Okay, I'm a 64-year-old US citizen, and I'm far from the six-figure income crowd. Since 2005, I've lived and worked overseas, so I've not been paying into US Social Security during those years. I'm eligible for Social Security income, but I don't plan to access it before 67. In addition to the above, last year, I became an independent contractor for a US-based company and started paying Social Security and self-employment taxes. Again, I'm planning to move to Portugal. Yeah, I know, really popular right now. I'm planning to move to Portugal in the D7 based solely on my savings, Social Security, and brokerage investments, not my digital work, my remote work, because I've been told my work as an international language assessor no longer qualifies me for the NHR. Thus, blah, blah, blah. If I declare my digital artwork, my digital work in Portugal, I'm looking at Portugal taxes around 28%, and I don't think that includes the Social Security as well, right? Portugal and the US have a Social Security tax treaty, which is actually called a totalization agreement. It stipulates that I should only pay Social Security tax in one jurisdiction, so the jurisdiction in which you are. Okay, so my question is, so we got to the question. Is there a workaround? Can I hide my US digital income for remote working by depositing into a separate US account where I would continue to pay US taxes on my independent contract work? Or would this be a big risk with high consequences when filing taxes in Portugal? Bottom line, if I'm paying almost 50% tax in Portugal, well, 28% plus the social charges, it might not be worth doing the work at all. I hope not. I love my work. Many thanks for your insights. Okay. Portugal, like most European countries, taxes you on your worldwide income. Like many European countries, there are carve-outs. So in Spain, there's a Beckham law. In Ireland and the UK, there's res non dom. Italy has it. Switzerland has a flat tax. Portugal's version of a carve-out is the non-habitual residence program, which allows certain categories of income to either be taxed lower than normal or not taxable at all. Unfortunately, it's a great scheme. I mean, it's good, but it doesn't really favor business owners or people who are still working. So that is something to consider. And you're right. Even if you were to qualify under the NHR as a high value added professional, and you get the flat tax at 20%, then you're right. You have to add Social Security onto that. So you're looking at over 40%. And if you don't get the benefit of being a high value added professional, then you could be looking at closer to 50%. So you're absolutely correct. It may not be worth it. We cannot, and I don't think any serious qualified professional would advocate hiding the income. It needs to be declared. If it is that work is being performed within Portugal, it needs to be declared to Portugal. It will be taxable to Portugal. Just like with the US, you have to file something called an FBAR, a Foreign Bank Account Report, or FinCEN Form 114. Portugal has the equivalent as well. So with Portugal, when you become tax resident in Portugal, you need to declare all your foreign accounts. It's not as intrusive or is not as explicit as the US disclosure, where you have to look at maximum balances, you have to disclose all of that. The US is probably one of the biggest ones, but yeah. But it does mean that you need to declare the account. So I would, just don't go to Portugal with anything but an intent to just follow 100% of the rules. And maybe if it is that it's going to be a huge tax burden to you, maybe it's worth looking at other jurisdictions. There's Spain next door under the Beckham law, although that has some, Spain has some, it's not the perfect solution. There's no panacea. There's no perfect jurisdiction. In Europe, there's always some catch somewhere, somehow. But, for the 5-year duration, the Beckham law may be a better deal for you. And it's close to Portugal anyway. But definitely go in there thinking, full disclosure, there is no workaround. It needs to be declared once you're spending your time in Portugal. Sorry about that. But yeah, hope that helps. Next question. I'm a US citizen who recently decided to pick up my work and move to somewhere with a better climate. Good for you. I've placed myself in Costa Rica for several months. I have confirmed that Costa Rica does not have any tax implications for non-residents working remotely for non-Costa Rican companies. So this would be once you're not tax resident in Costa Rica, so you're not staying long enough to trigger tax residency. Okay, that's fine. I have both 1099 and W-2 income from the US while I'm working remotely. Okay, fine. I have not lived abroad for more than 330 days. I left in June 2021. How does this affect my 2021 US taxes, if at all? How would it affect my 2022 taxes if I choose to stay abroad for the rest of the year? Okay, Dana, so great question. Great question. So from a US perspective, assuming that you have not, so you've been outside for less than 6 months. You can, I know when you mentioned the 330 days, you're thinking of the Section 911 foreign earned income exclusion, which perhaps is one of the best benefits for US exposed persons who are abroad. So the amount moves with inflation. I think right now for 2021 is 112,000. So like the first $112,000 of income is completely protected. You declare it on your tax return, but using a Form 2555, it is more or less sheltered from US tax. Now that applies to the W-2 income. So generally speaking, once you qualify for that, if you had W-2 withholding, it could be refunded to you. But it does not work with 1099 income. So with 1099, you'll be enjoy the Section 911 exclusion on the income tax. But remember, as an independent contractor, 1099 contractor, you also subject to self-employment taxes of 15.3%. That will still apply. Now, the thing is, in order to qualify for the foreign income exclusion, you do so in one of two ways. I have a really long article on this on our website, Issues Without Tax. We have like 2,000 articles on international tax and probably like 1,000 videos. But you can qualify in terms of the bona fide residence test, which is subjective and qualitative, and the physical presence test, which is objective and quantitative. So basically, just being very, very brief, the bona fide residence test, in order to qualify for that, you need to be a bona fide resident of another jurisdiction. You need to have a home there, a place of abode. You need to be paying taxes there. It'd be great if you have family there. So, you pay them, your visa allows you to be there for a while. So you are definitely a bona fide resident of a jurisdiction outside of the US. So you qualify that way. Other ways on the physical presence test, which is 330 days, right? So you need to stay out of the US. You can get a partial, potentially, I'm not giving advice, but this is something to take to your tax team. You can get a partial benefit based on the foreign income exclusion, because the physical presence test is 330 days, but it doesn't have to be in the same calendar year. So you can do a Form 4868 and apply for an extension. And that may give you time to count 330 days, you get an extension to October, right? And based on that, you can get a partial. So there's potential for tax optimization there. So speak to your preferred tax team around a partial exclusion based on filing an extension. But of course, regardless of what you do, remember an extension is an extension of time to file, not time to pay. Taxes are still due on April 15th, April 18th, so mid-April, regardless, right? So hope that helps, Dana. Next question. Okay, I'm gonna jump into another platform and pull some more questions out there. So sorry, when my Wi-Fi crashed, I lost some of the questions that were asked. So those who are in Zoom, if you ask a question before Kelly, please put it back because it's no longer in my feed. Anyway, so the IRS sent a letter to my address overseas. It took over 4 months to get to you. You're lucky. We know people that took way longer. It's nuts right now, right? I'm in Asia. It was stamped through Estonia. Yes, you're not alone. There's It's just a way it's working. It's being printed and mailed from other parts of the world. Okay. So I filled out and said and sent the form in December. Okay, it still hasn't changed. Okay. All right. So you have an issue with the IRS. You've reached out to them. If it is that you type something, okay, right. So best bet is to give them a call, right? Because right now we're applying by mail. Like we're in tax season already. In January last month, they had something like 6 or 7 million pieces of unopened mail. So this includes, we have clients whose 2020 returns have yet to be processed because they pay profiled. So sending something in the mail right now, that is not going to be processed in a hurry. And if whatever the notice that you got is time sensitive, you need to get on that phone. I know it's hard because the stats show that the IRS answers less than 10% of its calls. So yeah, it's going to be a long wait. You're looking at 2, maybe 3 hours on the phone, but you need to speak to somebody. If this thing is time sensitive, you need to get through to them, and writing a letter may not be enough because things are sometimes automated. So some of these notices just get done automatically, and whatever the escalation will be automated as well. So they don't hear from you in X number of days, whatever it is, the time that they've given, they move up to the next stage where there'd be a notice of intention to freeze your bank accounts, and it gets really, really messy, and interest and penalties are being calculated as well. So I'm sorry, there's no way. You need to get on the phone and really get this thing sorted out. Remember that you can also get full visibility of whatever the correspondence trail has been by going to irs.gov and registering for your tax account. So you can now, it's a new feature, using ID now. So once you're able to verify your ID, I did it, you do a video call with somebody, you hold up your ID, your driver's license or whatever, they verify you and they give you access to all your records. So you don't even need to wait on the mail. It's kind of like email, right? Because you can see what the latest notice is. So get on that. Do not let it slide, especially if you're outside of the US and maybe it's a big bill. Your passport can be affected. So please, I would get on that as soon as possible. Moving down. Okay, so someone's asking, I intend to spend 1 year in the UK next year. If I work remotely for a company in LATAM or the US, Latin America, the US, should I have to pay any taxes in the UK or my home country? If so, why should I? That income is not from a US source. I'll be kind of a tourist to them. Okay. So I know that sometimes the tax rules seem counterintuitive and it's not how we would logically see things, but it is what it is, right? So in this case, the UK HMRC, which is like the IRS in the UK, so Her Majesty Revenue and Customs, they have something called a statutory residence test, right? So based on the number of days that you are in the UK, and it's a test. You can go to hmrc.gov.uk and you can do the test. You just answer a bunch of questions and they will spit out an answer. So based on that, if it says that you are tax resident, you are taxable on your worldwide income. I repeat, you're taxable on your worldwide income. Now, remember earlier we were speaking about Portugal with the NHR as a carve out on that. So a way of, being a little bit more tax efficient. The UK does have something like it where you're res non-dom or you're resident non-domicile. So you can be taxed on a remittance basis. So you can be taxed on only income that is earned in the UK as opposed to something that's earned outside of the UK. And you may have seen that somewhere as you do your searches, but that really is designed for investment income, not for earned income, because you are exercising this, you're working in the US, even though you're working for someone that's outside of the US. I'm sorry, in the UK, even though you're working for someone outside of the UK, you're performing those services in the UK. And if you're a tax resident in the UK, you need to pay taxes on that, even if it's on a remittance basis, because it's being earned there. It's not investment income, it's earned income, right? So yes, then your question is, well, how are they going to know, right? Well, technology, right? So if it is that you are there for an extended period of time where you trigger tax residence in the UK, and the money is being wired back and forth using a credit card, whatever the case may be, HMRC can find out. They can. I would not mess with HMRC. I suggest that you speak with an UK accountant and work and if it is that you intend, so you're not yet in the UK, maybe there's an opportunity for tax planning. Maybe you can speak with, because once you're there and you trigger residence, it's probably kind of too late. But if it is that you plan to go, I think you should speak with a UK tax team. So and see if there's any way of optimizing your position, because once the clock starts ticking and you trigger that residence, it's done, right? But we cannot, and I don't think any, again, like I said before, no qualified professional would in this day and age advocate. We live in the age of transparency. You have tax authorities that monitor social media of its residents, right? If you are playing fast and loose with the rules, they're going to figure it out. All right, next question, scrolling down. If a US citizen renounces their residency, a US citizen renounces the US residency. So I guess you renounce, is there 10? Okay. So as a US citizen, you cannot renounce your US residency, even if you're not resident. So before I get to the rest of your question, I just want to stop then as a point, right? Even if you're not resident in the US, if you move from Louisiana to London, the IRS does not care that you no longer live in Louisiana. If you move from Miami to Milan, the IRS does not care that you're no longer living in Miami. You're going to be taxed on your worldwide income regardless. The only way around that is if you move to Puerto Rico or if you give up your US passport. So once you give up your US passport, that's that renunciation of your citizenship, then you would only be taxed on your US source income. So if you like have rental property or US investments, that may be subject to US taxes. But whatever you do outside of the US after that renunciation is normally out of the reach of the IRS. So that's how it works, right? So I'm going to the rest of your question now. So is there taxable transaction if there are property owners? Is there taxable? So, okay, I'm not too sure what you mean, but here's how I see it. So in the process of renouncing, there is something called an exit tax. The exit tax will be triggered if you're what we call a covered expat. So when you become a covered expat, in three ways, the two most popular ways would be if your average tax liability over the past 5 years is over a certain threshold. So let's say it's more than 172,000 per year on average, or if your net assets are in excess of 2 million. So then you may be a covered expat and you would be subject to an exit tax. If you want, we can go into how that's calculated, but you will be subject to an exit tax. Assuming that you are not a covered expat, then once you renounce and you walk away, you're subject to your US source income. So if it is that you do have rental properties, the rental income will be taxable. If it is that you sell your home or sell a home, then that transaction will be taxable as well, capital gains tax. So in terms of US real estate, basically you will still be subject to tax on whatever income or that arises from US real estate. There are exceptions, as there always is, right? I think we recently been speaking to clients about the portfolio interest exemption. So there are exceptions, there are workarounds, but they're not easy. They're pretty relatively complex. But generally speaking, yes, your US real estate will still be subject to US taxes even when you renounce. Moving down. Have you heard of any new upcoming digital nomad visa countries? Yes, Kelly. And that list is getting longer every day because countries are, catching on. Hey, this health crisis that we're going through, the name that I can't mention, otherwise we get censored, this ain't going away. Therefore, we need to attract longer term visitors as opposed to people who just come in for a weekend or 1 or 2 weeks vacation, right? We need to look for longer stays. And one of the pioneers in that space, of course, has been Barbados, but there have been others as well. Bermuda, there's a whole list is getting longer. I think Brazil just recently announced one. South Africa is thinking about one. You know, Thailand, Indonesia, therefore Bali. So the list is pretty long. You just need to work out, what your options are. And once you have decided and you've narrowed them down to a few, maybe then you can speak with your preferred advisor about the tax consequences to you moving, because last thing you want is to go and get trapped in a tax situation, right? Although there are, like Barbados being one of the forward thinking ones, they have passed local legislation so that you will not be taxed, even if you're working remotely, whatever it is that arises from you being there, not subject to tax. Even when you are there for a year on that welcome visa, you're not going to be taxed. So yeah, good luck, Kelly. Okay. Okay. All right, Lysandra. Fantastic. So any more questions? Okay, somebody's asking about being resident, not being tax resident anywhere. So I'm assuming that you're not American, right? Because as I mentioned, once you're a US person, you're subject to taxes on your worldwide income, regardless of where you are, right? Doesn't matter. If it is that you're not American, then yeah, it's not as easy as people make it out to be on the internet, but it is possible. It is, you just need to keep moving. You need to be constantly moving, but it is possible. But what we've found with our clients, our clients are 6 and 7 figure earners, right? So they, their situation is important, and if something happens, the consequences could be dire for them. So even though people talk about about taxes when it comes to being a perpetual nomad, they don't often think about banking and banking rules. So what the governments have been doing, they've been using financial institutions as police, more or less. So you've heard about FATCA for Americans. There's something called CRS, or the Common Reporting Standard, or the Automatic Exchange of Information for non-Americans. But basically, they're also under that, so these are just frameworks for information exchange. So even though you think that the UK doesn't know what you're doing in Bali, that bank account, that bank that you're banking in Mandiri, or whichever bank you're using in Bali, may be reporting you to the UK. Or, or if you're doing something in Singapore, but you're a tax resident in Bali, then the bank in Singapore is probably maybe reporting you to the Indonesian tax office. So there's that exchange of information going on, but there's also so the tax authorities, if it is that you are a tax resident and not doing the right thing, they can catch up with you. But the banking rules, the AML rules, and client KYC rules, so anti-money laundering and know your customer rules. So they always need to know how you're earning money. So if it is that you are independently wealthy and all you're doing is living off interest, well, that's fine. But if it is your money being earned in some way, shape, or form, the bank would need to verify that it's legit. And, banks feel very uncomfortable when you can't give them a fixed place of abode. They get very, very nervous. And their knee-jerk reaction is just to close their account and get rid of you. Alternatively, sometimes, when there's an audit or whatever, and they just want to update their records, making sure the KYC stuff is being done, and they don't know where you're being taxed, because that is a question. They're going to ask you, where you tax resident? They get very uncomfortable if you can't tell them. And, I give the story all the time. We've had several clients in Southeast Asia who've been living there for a while, and obviously were banking there. And they're originally from parts of Europe. At some point in time, they want to return to Europe. Whether in one case, one guy his mom was not doing well health-wise, So he wanted to go back to his European country of origin. And, he gets back home and he's trying to wire money from his Southeast Asian bank to his European bank, and they're blocking it. Why? Because they need to verify this transaction. How was this money earned? And if he can't demonstrate that, and no bank really would accept an invoice, really, because give anybody 5 minutes on Microsoft Excel and they have an invoice, right? What they look for to make them feel comfortable, they'll ask for different things, but I think one thing that makes most banks feel very comfortable is a tax return. A tax return from a government, it's a government document that says this money's been declared, this money has been taxed, it's clean, it's legit, nothing to see here. So circling back to your question, you can be a perpetual nomad, you can be resident nowhere, but be conscious of the banking rules, and you may be blocked or prevented. You may be kicked out of the banking system, or unable to transfer your money internationally because you can't prove it, right? And even that bank where it's being held right now, they may eventually have problems. So just a heads up. Next question. So I'm just going to check some of the other platforms for any questions that may be asked. Okay. Nothing here. Nothing there. Okay. So one more, okay. For those who were trapped, well, unable to travel because of COVID, sorry, I can't use that word, because of the health crisis. And okay, so you may have triggered tax residency. So it really depends. Some countries were better than others. I think one of the best in class was probably Australia. So the ATO, the Australian Tax Office, they were pretty proactive. So they knew that flights weren't happening, and basically the borders were closed. You needed to get permission to enter Australia or leave Australia. And for those who were in Australia and unable to leave and trigger tax residence as a result, the ATO has been pretty understanding. I mean, they're probably one of the better actors. And then on the flip side, you had Spain. So Spain doesn't care. Spain doesn't care. Spain is probably one of the more aggressive tax authorities to deal with. So they don't care why you were there, you couldn't leave. They don't want to hear all of that. They just want their money. So it really depends on the jurisdictions that were triggered by you being there and unable to move on. So you were there longer than you intended to be because of circumstances beyond your control. So again, you probably want to speak with a tax professional qualified in the jurisdiction in which you're having challenges, and they can perhaps help you work through whatever the tax office is telling you. So good luck with that. Okay. On that note, any more questions? No? All right. So thanks for your time. Appreciate it. Sorry about the technical issues, but I'm having issues with this hotel Wi-Fi. Again, htj.tax, we have these live streams every week. Feel free to join us at any time or send us any questions, and be happy to speak with you. Okay. Thank you, Kelly. Thank you, Dana. This has been recorded and it will be available on your preferred podcast platform. See you next time. Bye-bye.